Hey, what's going on? Samuel Joseph here again for Elevate Forex, and today we're going to be talking about order blocks. In our previous video, we started off talking about what the markets are. We introduced ourselves to the markets. Later on, we talked about what structure is, and we said the importance of structure was to help us identify areas we could trade from. We said with the aid of structure, we have an idea of where price is going, and how we can get involved in the markets, and we're also able to isolate areas on the charts where we can trade from. And we marked out premium levels, discount levels, and we said based on structure and understanding of a trend, in an uptrend we'll be looking for buying opportunities, and we're sure to look for buying opportunities at discount areas into premium levels, right? And we said if it's a downtrend, we're looking for selling opportunities from premium areas down into discount levels. So this class is going to be on order blocks, giving us an idea of locations of price or areas on the chart where we should be getting involved in the markets. Now, these are places where we'll place our entry orders, be it a buy order, a sell order, a buy limit, sell limit, buy stop, sell stop, whatever the case may be. And this is what we're going to discuss in this class. It's important to know these areas so that we can have good risk to reward ratios in our trading, and it will help us, have that good risk to reward and enable us place, profitable trades in the market. Okay, let's jump right into it. So what are order blocks? But before we proceed, here's my promise to you, okay? So I promise that at the end of this class, at the end of this video, two things are going to happen. One, we'll be able to identify order blocks on charts, so we are able to identify areas we should be trading from. And two, we should be able to identify entry opportunities on order blocks. Now, not all order blocks are supposed to be traded, and there are some that should be traded and some that shouldn't be traded. We're going to do a little bit of that today in this video, so let's jump right in. So what then are order blocks? Order blocks are simply areas on charts that we're looking to get involved in the markets on. And I'm going to give you an example. So take for instance, now right from structure, take for instance, we have a trend moving in the manner like so, right? And you're looking to get involved in the market at a particular area. These, we're able to identify our structural areas. And then you've identified the trend, that the trend is an uptrend, and you're looking to get involved in the market. At what point should you be getting involved in the markets in? Now we're able to also mark out a trading range for ourselves in previous video. If you haven't seen that one, I strongly suggest you go and see that particular video. But here's a little cheat code so you know. Whenever you get a trend, let's say we classify our trend as a 1, 2, 3 move. So let's say this is move number 1, move number 2. Pardon, this move is move number 1, right? Then this move from this point, from this higher high to this higher low is move number 2, and then this is move number 3. Usually when you're marking out your trend, you like to mark your trend from move number 2 to move number 3, right? That is a small cheat code so you can always remember. So let's say you've marked out your trading range, not your trend, your trading range. You mark your trading range from move number 2 to 3, and you're expecting pullbacks. Actually, you're expecting the market to do something like this and continue its movement higher, creating, opportunities for you to get involved in. Now, those areas we're looking at opportunities to occur are order blocks. Now, before I even delve deeper into that, I would like to explain a few concepts. Now, there are several theories that hold true in the market, right? And we're going to discuss a few of them. We have the Elliott wave theory, we have Dow theory. Dow theory suggests that price moves in a manner like so, right? With highs and lows being put into place in the markets. Let me draw that out properly. So Dow theory suggests that the market moves in a manner like so. Now we have another school of thought, which is Wyckoff theory. And Wyckoff holds, I'm touching a little about Wyckoff because I want to introduce you to the concept of the composite man. or enigma, as the case may be. Now, different people have different names for what I'm about to share with you. Now, there are different kind of traders. We have the smart money traders, we have the retail traders. There's a lot of names. We have smart money, dumb money, whatever the case may be. All right. But now there are people who, there's no strategy that cannot be a profitable strategy. So even if you're trading, support and resistance, trend lines, touch of trend lines, and all of that, it doesn't mean it's not a profitable strategy. But if you seek a deeper understanding of the markets or whatever strategy you're trading, make sure it's profitable to you and it supports your own belief system. Okay. So now back to what I was talking about. Let's say, for instance, a lot of people expect the market to move like this, Dow theory, right? Now, there are a series of patterns that tend to repeat themselves, and some traders prefer to trade these patterns. Some you would be able to identify stuff like trend lines, and some people are trend line traders, right? They believe that once the market takes off and makes such moves, it's obeying a trend line, moving in a certain manner. And of course, because it has happened in the past, what do they believe? They believe it should happen again in the future. So what are they expecting from this kind of move? That price should pull back down to this same area, respect this trend line, and then continue its move to the upside. Well, Wyckoff theories that talks about the composite man, it's a little bit different, right? So speaking about the composite man, here's a little idea I want to share with you. Now there's a belief, Now there's a belief that the composite man have, and I would like to liken it to the way we trade, right? It's some of ICT concepts, smart money concepts, and that's the methodology we apply when we are trading. Now the composite man believes that liquidity moves the market, and price would always head for liquidity. We'll talk a lot more about liquidity in subsequent videos, but for now I just want to introduce you to these concepts. And by liquidity, I'm simply referring to stop orders in the markets and stop losses in the markets, right? What that means is, for price to move from point A to point B, somebody has to be selling and another person has to be buying. And if the buys in the market supersedes the sells, then the price is going to rise. But however, for this to happen, for price to move from this point to this point, for the institutions to be able to take price from here to here, they need people to sell to them. Take, for instance, if you want to buy a commodity, you need someone to sell that commodity to you. In the same manner, if you want to buy a currency, you need some people to sell that currency to you. So the idea of the composite man is this. The composite man is going to deliver price in such a way as to make people feel like the markets are going to buy, so that the composite man can sell to them. That is in a scenario where they want to take price lower. And also the composite man believes that for them to take price higher, they have to make people believe that the market is going to go lower, so that people can sell their positions to them and they can buy at cheaper prices and take price higher. Let's represent this concept on the chart. Let's say, for instance, we see something like this happening based on Dow theory still. What is the next thing that comes to your mind? That the price is going to come this way and then continue moving up, right? And why do you have this belief system? Because you've seen it happen in time past before. But however, the idea of the composite man is letting you know that as price has made this move, he's going to deliver price in such a way that he'll make you feel price is still going to buy. Why? So that he can sell to you and take prices lower. And that's the idea of the composite man. Let's look at a typical example. Take, for instance, you have price moving in a manner like so. Now, there's a lot of people who trade retail concepts and trade a lot of patterns. And now, if you're a pattern trader, you would understand that when you see certain chart patterns like double tops or double bottoms on the chart, you'll be expecting to sell and buy respectively. If you see double tops, you'll be looking to sell the market. If you see double bottoms, you'll be looking to buy the market. Let me go ahead and show you these patterns. What do I mean by double tops? What I mean is you see the market move like this. You see a movement like this, forming something like an M on your chart, which means there's resistance over here, right? Price is resisting this area. Therefore, you'd be expecting for prices to sell from that zone. This is a double top. The reverse is the case for a double bottom. Now, let's say you see price move like this. Now, the idea is once this happens, a lot of people will be looking to get involved in the buys here. Why? Let's say you see something like this. What are you going to believe? Is price comes here the second time, price rejected from here the first time. If it gets to that same level, it's meant to reject again the second time, right? And that's what gives them this belief that if you're going to enter the market for a sell, you should be entering at areas here. Now, people who are entering the markets here, where do they have their stop losses? You guessed right, just right above here. Pardon me. If you're selling in the market, you would most likely have your stop losses just above the double tops, right? Let me go ahead and mark that out properly. Yes. Because you believe that this area of resistance here is supposed to hold, right? That's the idea that retail traders hold. This is how their strategy operates. Now, the composite man is out to get everyone using every kind of strategy. At some point, even those who trade smart money are taken out of their trades based on how the composite man delivers price. Now, with this belief system, if you're getting involved in a trade here, you would have your stop loss here, which means you are selling the markets at this point and you are looking to get out of the market at this point. That's if you're wrong, you will be letting go of your position here. And remember, if you are selling out, you are closing a trade, what's happening? Somebody else on the other side is taking that your trade. So if you are selling, which means somebody else is buying from you, right? So the composite man lets you know that if you are getting out of your position here with a stop loss order, that means he's taking the opposite side of your trade, which means he's buying that sellout that you initiated. A stop loss is another to take you out of the market. So once you are leaving, the money you have lost will be made by somebody else. I don't know if you understand my concept. If you don't, please just watch this again, but let me try and simplify it a little bit more. Take, for instance, you're looking to get involved in the markets over here at this point, and you have your stop loss placed above here. What that simply means is if you're exiting the market with a stop loss, somebody else is buying your position at a cheaper price, which means you entered here, but price moved a little bit higher than the area you expected it to move from, which means your position went in a loss. Someone else who got involved at that higher prices is going to get more returns when you leave the market, when you are going out of the market. This is what brings us to the concept of liquidity in terms of stop losses or stop orders. So let's say you are exiting the market here, somebody else is taking that position from you over from here. Now that we have that understood, let's move forward. Now, what the composite man does is he delivers price in such a way that you feel the market is going to move in a certain direction, only for him to take you out of your trade so that he can get involved in that trade. So in this case, if I wanted to sell the market and I was the composite man, I would deliver price in such a way that will make you want to sell your position, only for me to have you taken out and then proceed to take price in that direction I expected it to go in the first place. What that simply means is liquidity has been engineered in terms of stop losses, making you want to exit the trades from here. After that liquidity has been taken, I can now go ahead and move in the direction I want to go. Similarly, when you are having this expectation for a buy trade, right? You are getting involved in buys around here. What I'm going to do, or what I'm going to try to do, is make you feel like the market is going to push up from here, only for me to take you out of that trade and then proceed in the direction where I expect price to go. Now, this is how the composite man tries to deliver price. So if I'm going to withdraw, if I'm going to draw again that trend we saw using the Dow theory, let me show you how this might look like on the charts before we even go ahead to look at it on the charts. Remember, we are still talking about other blocks. So don't lose context of what we're talking about. I just want to take all of this off the chart. Excuse me. Okay, there you go. Off. Okay, now let's redraw again this trend we drew in this manner, because let's be frank, you'd rarely see price move like this on the charts. So it's not as easy as seeing a high, a higher high, a higher low, higher high, higher low for you to get involved in the market. If it was that easy, everybody's going to be making money trading Forex, but that's not the case, right? So let's look at how we most likely would see price being delivered. You might see something like this, a push. Then you see something like this. Let's say this. Then you see something like this. Now, what is constantly happening? You begin to see the cycle of liquidity being engineered, traders being taken out, and then price proceeding to move in the expected or the previously anticipated direction. The same thing happening over and over and over again. Now you understand why we handled structure first, because structure would help you develop a thick skin against some form of manipulations. Now, it doesn't mean you win all your trades and you'll be right all the time. There are certain instances where the market invalidates a structural level, and we have no way of knowing that, right? We have no way of knowing that this level wants to hold or is going to continue to hold. But what we do know is if this level decides to hold, this is the most likely area to be taking a trade from. That's a probabilistic mindset when it comes to your trading, right? So let's say you see something like this happening on the charts, because this is most likely what you're going to see every day when you open up your charts to look. What do we see here? We see liquidity being engineered in terms of maybe a double top, and then we see that double top taken out with a sharp move before price pulls lower, and then the next thing you see, it moves to the upside, and it repeats this circle over and over again. Sometimes it might not just be a double top or a double bottom. You might see something more like a trend line, forming. Let's say you see price moving in a trend. You see some form of a trend line, and then the next thing you know is you see price has taken that trend line. Let's say maybe you saw this happening, right? And then you see a lot of liquidity, because people who are going to be trading this would like to be getting involved here. This came over here the first time. Let's go ahead and mark that out. Let's say you saw price here, you saw price here, you believe this was the structural level, and then next thing you know, you see that price has been taken out, right? And then proceeds to move to the upside. This happens over and over and over again on the charts. So I want to explain to you how you can get involved in the market and avoid some of these takeouts so that you can be involved in the profitable trades. So what we are trying to do is follow the footprints of, Enigma or Smart Money or whatever name you choose to call the algorithm. There are different names, different theories, but I just choose to see it as a strategy that you use in engaging the market. So let's proceed. Now we're able to identify something. Let's say, we have a market that moves like this, moves in a manner like so. And from what we've discussed so far, what was the first thing we talked about? Structure, right? So let's go ahead and identify structural areas on this schematic. So we have this here being our low in the market, or let's say this is our first point in the market. The next point we'll look at will be this. We'll look at this. We'll look at this. We'll look at this and this. Now, our knowledge of structure has helped us to do one thing: identify the real areas that price is going to be able to move from. What's the next thing we should be looking out for? Remember, after you've identified structure, you should cut out for yourself a trading range. Eliminate all the noise you see in the market and find a range in which you would want to get involved in the market with. You want to find out the area which you will be trading from. That's what you want to do, right? So the next thing, remember from our cheat, we said in case you have a 1, 2, 3 move, where do we mark our range from? 2 to 3, right? And we're assuming that 3 has already let you know that, there's going to be some reaction over here. Let's keep this over here for now. So let's say we've identified 1, 2, 3. We go ahead and we mark our trading range, which happens to be 2 to 3. 1, 2, 3. Remember, this is our most recent break of structure. This move over here. So if we're going to mark this out, let's say we'll call it a break of structure. This was the move that led to that break of market structure. So let's just call it a BMS. If you watch from the previous video, you would see how we're able to get these templates done. So if you haven't seen it, I suggest you go and watch that video before you come back to this one. All right. So let's say you have a break of market structure over here. We've marked that out. You've identified your trading range. Now remember, this is an uptrend. So what are we looking to do in an uptrend? We are looking to, exactly, you guessed it correctly, buy. If the market is an uptrend, we're looking for buying opportunities. And again, where are we looking for these buy opportunities? Again, you guessed correctly, at discount levels. So let's say we have those two levels. Let's go ahead and mark them out again. This is premium. This is the premium level. Okay. And then where's the next one we have? Discount level. You got that right. So we have premium and we have discount level. So in an uptrend, where are you looking to get involved in? You guessed right again, at the discount level. So now, what is our job? What are we expected to do? At this point, all we want to do is sit on our hands and watch how price moves. And we're looking for opportunities at around the premium levels. I mean, around the discount levels. Now, in these discount levels, what are we looking out for? That's what brings us to the idea of an order block, right? So we'll be looking out for order blocks in which we should be trading from. Now, let me take your mind back to what I said about the composite man. Remember when we're discussing certain manipulations that happen in the market? Let's say you see a double bottom and you expect price to move from there. Then all of a sudden you see that price comes lower than that double bottom you are anticipating the move to happen from. Let's say you identify this as an uptrend, quite all right. You were correct. And then all of a sudden you saw a double bottom. You said, wow, good, another opportunity to buy in the market, and place your stop loss right beneath your entry price, which should be over here. Another good assumption. But what happens? You see a little move out of that area and you are excited that, okay, perhaps price is going to keep moving in an uptrend, move bullish, and I'm going to make money from this trade. Then all of a sudden, what happens? You see price drop below the area you got involved in, creating somewhat of what we will call a demand area before price now proceeds to move to the upside. You understand what that happens, what that means now. So now what we have is we've seen a manipulation. We've seen how smart money has taken out those initial buyers in the trade so that they can get involved at even cheaper prices, and they've taken prices higher. Now, as smart money traders, or borrowing from the smart money concept, what are we expected to do? We are awaiting a mitigation of this area. Now, this zone that was left behind here is now what we refer to as a demand zone. Now, this demand zone is the area in which we will most likely be looking to get involved in the market. This becomes our demand zone. So once price pulls out from here, this area that was left unmitigated is where we are looking to get involved in the market for buys. It could be anywhere. It could be here, it could be here, it could be here, but it should be at our discount level, and there are certain rules that we are going to follow in picking the right order blocks when we're looking to get involved in the market. What have we done so far? So far, so good. We've isolated an area to trade from. That's our range high and our range low. What's the next thing that we've done? We've been able to identify a trend to know what kind of order we should be involved in, or what kind of trade we should be placing. When we have an uptrend, we're looking to buy. So we already have a buyer set in place that we want to buy. We already have a range that we want to be trading. We already have an area we are looking to take those buys from. Now, what's the last piece of the pie? We are looking out for specific areas where we can now enter for our buys. We already know that is this area, but we can't just be buying off the bat every time price comes into discount. No, that would be disastrous. But what we are looking out for is to find an area that will give us a good risk to reward ratio, which we refer to as order blocks. These demand zones are those zones that create those order blocks that allows us the opportunity to get involved in the market, to be able to place those trades that we want to take. right? So now these demand zones that we have over here, they are the points we are interested in taking our trades from. So let's call it a point of interest, right? A POI. So that's our POI. We are interested in getting involved in the market at this point here. So at this point, that's where we are now going to put our buy entries and anticipate price to push higher so that we can make the bucks we're expecting to make in the market. I believe this is understandable. So now let's go ahead and look at these examples on the charts. Let's see exactly what we want to do on the charts. So what currency should we? I don't want to look at anything on my watch list. Let's go with USD card. Let's go with USD card, for instance. USD card as the US dollar, Canadian dollars. If you notice, we haven't really talked about currency pairs or that sort of thing. We haven't really looked at all of that, and that's because I want you to be able to start trading almost immediately after watching this video. That's the reason for this course. I want you to have what it takes to identify a trading opportunity, get involved in the markets. If you notice, right from our first video, we talked about creating your own account. After creating your own account, we proceeded to show you how to verify your documents, get started almost instantly. So at the end of this course, you should already be able to form a bias in the market, know when you should buy or you should sell. And in our pro course, we'll delve a little bit more deeper in some of these concepts that I've explained. Now with this alone, you are even able to get involved in the market. And this is okay if you're just looking for a few bucks from the market. But if you really want to take yourself really seriously, if you want to really develop a trading edge, you're considering going into trading you want to be a full-time trader, then I would suggest you opting for a more professional course, right? Like our advanced course, where some of these concepts are explained a bit more in so much detail. All right, so let's jump right into it. So we're looking at USD card. We don't want to see where price is, so I'm going to just even this out, and let's look for okay, let's trade from here. Let's take that out from here. Okay, so let's see what we have now. Right off the bat, let's say we identify this trend as an uptrend, right? Price has constantly been pulling to the upside. What's the first thing we do? Identify our structural areas. So let's just say, let's mark out this point, this point, this point, here, here, here. And then we saw this pullback, liquidity being created again. Like I said, the market always moves to engineer that liquidity in form of what? Double bottoms, double tops, trend lines, whatever the case may be, just to take out that liquidity and then move in the manner it wants to move. So once you have a firm understanding of some of these concepts, trading becomes easy to you. So let's proceed. So now what do we have here? Remember, step one, you identify the trend. Done. Uptrend. Step two, what are we trying to do? Mark out a trading range. So where's our low? This is our low. Where's our high? Remember the 1, 2, 3 move. This is move 1, move 2, move 3. This is all the form of mitigation. Now what do we have? We need now identify our levels. What are those levels? Premium, exactly. What other level do we have? We have premium level, and then we also have the discount level. Great, you said that right. Discount level. So now we identify our premium level, identify our discount level. So where are we looking to get involved in? At our discount level. But are we just going to buy off every area on the discount level? When price dropped here, are we just going to buy off immediately? No. We are looking out for areas to get involved in. Where are those areas? Order blocks, demand zones. So let's go ahead and take a look at this. And I'll use this to explain some of the criteria you should be taking when you are looking to get involved in trading. Now, let's look at all of this. We saw this move. We saw liquidity being engineered. So, once you see it, you can't unsee it. I'm beginning to see a lot of moves and see it play over and over and over again in the market. But let's isolate ourselves to our trading range, okay? Let's just isolate ourselves to our trading range. So now one of the things you should be considering while trading an order block is this: it has to take out liquidity, either both internal and external liquidity, preferably. What do we mean by internal liquidity? When you have a range, right? This range, let's say this is our trading range, our range high and our range low. Let's go ahead and mark that out. This was our range high over here. Let's identify it as our range high. Let's identify this area as our range low. If you look over here, we have our range high, here we have our range low, right? Great. So internal liquidity refers to all form of liquidity that is still within this range. So all of this, where people are going to be having their stop losses over here, it all refers to internal liquidity. So let's do this replay from here. Nope, that's not what we want. Let's take this from here. So that, okay, let's take this from here. I've already identified the level where price moved from, however, but let's look at this together just so that, you know, we can make this easier. So we have price moving all the way up here. We've seen our 1, 2, 3 move. We've identified our range high, our range low, our structural points. Great. So let's go ahead and now look for opportunities for us to take this trade from. Now over here, what you notice is there's no unmitigated zone that led to a break of structure from here, because you ask yourself, okay, this level was in a premium level. It took out this liquidity that was engineered here, maybe in form of a trend line. But where is the other block we should trade from? We can't find one over here. Let's look for another level. There doesn't seem to be any area that has been unmitigated over here. By mitigated, I'm talking about, you see price coming into that area. Now let's give certain criteria for you to consider an order block a tradable order block. The first criteria is it should take out internal and external liquidity. That's 1. 2, it should possess some form of a fair value gap. Now let me introduce you to that concept. A fair value gap refers to a long candle. Some people call it a void, a liquidity void, right? So let's say there are instances where you have 3 candles. Let's do this. Let's give this a green color. Let's say this is a green candle, a bullish candle, right? And then you have another candle right beside it. Let's say this candle has wicks. Let's go ahead and give it wicks. Okay, nice. That's a nice wick. Let's take this wick. Okay, let's give it wicks. No, let's give you a wick here. Yes. And let's take a third candle from here. Let's make you green in color. Great. So now, assuming you see something like this, usually for efficiencies to be in the market, right, we don't want to see any form of inefficiency. This is not a healthy candle. Seen by not a healthy candle, I'm not talking about its anatomy. I'm talking about the fact that there was no way for buyers or sellers rather to get involved in this market. It was completely buy dominated. So who was selling to who at this point? It's a concept I want you to use in understanding this. What's important is to be able to tell the story, right? Now I'm just wanting you to have an idea, or have this idea at the back of your mind. When we had this long push, this green candle, this bullish candle, depending on the color of your chart, it could be whatever color, right? Now, what we want to see is for price to effectively fill this entire area. That liquidity void that I'm talking about is the space that has been created from the wick of this candle. Let me mark that out properly. A liquidity void is the gap that has been created from this wick we have over here to this wick we have over here. There's an inefficiency that exists here. Let's go ahead and look at it on the chart. Now, if you notice how price moves, when price gives a wick, the other wick comes back to close up that gap that is there. Price moved down heavily here. There was a wick that came up to close that gap. Over here, there's an inefficiency, right? But now we don't trade every inefficiency we see in the market. That's why an understanding of why you should be doing certain things is more important than just having regular patterns at the back of your mind. So let's look over here now. Why should we be considering this other block? Remember I said the first criteria should take out internal and external liquidity. Great. The second criteria is it should contain a fair value gap. There should be a fair value gap before that other gap, that other block was formed, or after that other block was formed, as the case may be, either in a buy or a sell market, right? So over here, what do we have? You can see this bullish candle with this inefficiency we're talking about over here. What do we have here? There's an inefficiency. So we can mark this area out as our desired order block, the last down candle before the up candle. That's what some people choose to call it, right? So let's say this is now where we'll be looking to get involved in the market. Let me go ahead and make that hash. So let's call this our what? Our POI, right? So this is our POI. Now let's watch how price reacts on getting to our POI that's at a discount level. So let's go ahead and watch this. We need to see price move. Okay, there was first an inefficiency here. It took out this liquidity. So let's see what happened there. It gave us a small, give us a small move, a reaction from that zone, but it didn't just reverse from there. It kept on falling lower. So let's keep going. This is one area. Where's another area? There's still another form of inefficiency around here. Let's proceed, right? And this is where probably price is reacting from. But let's see what we have. Okay, still have price moving. We haven't seen price break any structural level, so let's just watch as price moves. Let's just keep watching. Let's keep watching because we still have price at discount. Okay, we still have price moving. Let's try and speed this up a little. Now remember, we are considering this as our point of interest. Okay, so we still have liquidity being engineered, right? We'll talk a lot more about this subsequently in subsequent videos. What I just want you to observe is where price reacted from. Okay, so it's moving between premium level and discount level. Seems like okay, we have price coming down here, right? So all of this liquidity that has been engineered is being taken out. Let's go ahead and frame a buy entry for this, right? So let's say our target is our range high, right? I want you to see, let's see how price moves. Now it could just, pull all the way to the downside, or we can get an entry from here. If this truly structural level wants to hold and we want to see price, push up to the upside, then this level will most likely hold. This liquidity is going to be taken out and we would see price push to the upside. Okay, so let's go ahead and observe. Okay. Over here we have a tap into our zone, right? That's the imbalance we had here. Okay, just right at the region we're looking to get involved in the market, right? So let's see what happens from here. We're in the trade already. Okay, nice reaction from there. Let's pause it over here. Now what do you notice from here? We saw price pulling to the downside, right? We've seen a break of structure. This signifies one thing. This lets you know that the buyers are getting stronger in the market. We saw all of this. This was a structural level on a smaller time frame. We have to understand that markets are quite fractal. What I mean by that is everything that happens on the lower time frame also happens on the higher time frame. We're on the daily time frame, and all the individual movements of these small candles are what makes up the overall or the gross movements of the bigger candles, right? So let's look at this now. So now over here, what do we observe? You can observe that this area got broken. Now the next thing we look out for is other trading opportunities, right? Let's say now we mark out our range again, our range high and our range low again, right? Then what do we have? Let's say we identify this as our range low We identify this as our range high. Now, still within this trade, we still have one trade running. Get that at the back of your mind. Then we have price pushing up over here. Now, what area do we see that has an imbalance? We have this area with an imbalance. Okay, what area do we see that has taken out liquidity? We see this area has taken out liquidity. Now, what area is it? In our discount area or at our premium area? Where should we be looking to get involved in? At discount areas. Okay, so let's go ahead and mark out those areas. This is premium, first of all, to make it easier. Premium, right? Good. It's premium. Then where do we have discounts? This is discount. So we are looking to get involved at discount. So we are looking for more discounted prices for us to be able to get involved in the market. And what's the location we're looking to get involved in? At an order block below premium levels, at discount levels. So now this looks like a very good area to trade off of, right? It's at equilibrium. It's at our midpoint, not necessarily at premium or at discount. So this looks like a good level to get involved in. But let's see price's reaction from where it is right now before we go ahead and mark out that area. Okay, so we have price already leaving, taking out this. So this is not the area we're looking to get involved in. Which area necessarily led to the break or to take off this liquidity? It had a little bit of imbalance in between before the move was formed. We haven't gotten a region yet to trade from. And remember, like I said, sometimes there might be areas of where you might not see an opportunity, in quotes. So you have to be reactive to the market and wait carefully before you get involved in any trade. So let's go ahead and map this out. Let's play and see what we have from here. Okay, we didn't necessarily get an area to trade off of, but what do you see here? All the liquidity that we had engineered here taken out. We can see a large institutional candle coming to play. This is an order block right here, an area that took out liquidity. If we're going to consider this and we decided to consider, let's say for instance, this trend line liquidity, although this had already been taken out, but this was at the more discounted level that we have on price. We have another block formed over here and we can see price moving up to the upside. Let's go ahead and follow through and see what we have. Okay, at this point we have a break of structure again. So we have, remember we're still in this first trade. We didn't get any opportunity to get involved at this first pullback. Then we see price breaking up to the upside again. Remember, we mark out structure. 0.1, 0.2, 0.3. This is move 1, move 2, move 3, right? Around this area, we have move 3, right? So let's see where we can. Okay, we have some form of reversal over here. Let's go ahead and mark our trading range again. Remember, range low, right? Those are the steps we take. We just want to keep it very simple. What do we have here? Range high. So we have a range low, we have a range high. We want to be trading within this range. We picked this because we saw, a very, very good reaction from this area. There was a rejection from here. So we have our range low, we have our range high. Now, what areas are we looking to get involved in the market? What move took out liquidity? We have this to be our origin. There's an order block. We can see there's a lot of imbalance over here. Let's go ahead and identify premium levels and discount levels again. We have this. I'm just going to drag this from here. This is our premium level. This is our discount level. So what opportunities can we see at this discount level to trade from? We have this at equilibrium just like we had here. I'm not very comfortable with this move. So, however, I see something else around here. This serving as an order block. Now, it didn't necessarily take out any form of liquidity, but if it does, that gives you more, it stacks up the odds in your favor, right? There was no form of, there's a little bit of an accumulation over here. Price took out those that were getting involved around here for this low here. Then we saw price push to the upside, taking out external liquidity. So my reasons for selecting this area first is because there's a little bit of imbalance here. Remember our definition of imbalance I showed you on the previous candle, just right over here. Yes, if you notice, there's this void I was explaining right over here. We have something similar. If you zoom into the chart around here, you discover that it took a while for price to move from this week to this week. Over here to it's something similar from this week to this week. There's also an imbalance here. So I'm considering two areas now on the charts, because you never know which area is going to hold price from. But this is the first area I'll be considering to take a buy from. Now there's what we call a risked entry, and we'll have a reduced risked entry. I will explain these concepts when we talk about risk management, but for now, this is the first area I'm looking to get involved in. This is my first POI, and I'll be looking to take trades at this POI. Now what happens if this POI is wrong? I'll concentrate on the next POI, but I'll show you in subsequent videos how to know which POIs are going to hold and which POIs are not going to hold. Now this is the other block that has been formed. It has taken out external liquidity, and I'm looking to get involved in this trade. Another reason is because prices are discount. Price would be, this area rather, is going to be at discount. So let's go ahead and see what happens. Okay, we have price approaching that area. We're going ahead to take a long from this area. Our stop loss is just going to be here. This was filled, so I'll be comfortable having my stop loss here, just a few pips under the entry, and then my take profit. Let's just say at the end of this zone. But however, all of this is the internal liquidity. Remember the external zone we're looking to trade to. So that's where my range high is. I'll be looking to hold this trade all the way up. So you can see with this, I'm getting a good risk to reward ratio. I'm risking a little amount of money with the hopes of making bigger amounts of money. I'm risking, this is a 1:22 trade. You don't necessarily have to get such entries. You can do a 1:10. A 1:10 is okay. This is 12, 1:10 should be good, right? So now let's see how price reacts from this area, just off of the idea of ranges, trend, and other blocks, right? We haven't even delved into more complex concepts, but let's just follow through. Let's see what happens here. Okay. Okay, there we have it. We saw price push into that area, and we can see the rejection we're getting from this area already. That's an order block. We can see the rejection we're getting from this other block. So let's see how it moves. What do you notice again? Price has broken out yet again. What do we have? Another lower low being formed, lower high, I mean a higher low and a higher high being formed. But I'm not going to look for another entry. Let's just watch how price behaves from here. Let's see price's movements from here. We're just going to hold these two trades. We're in the first one. This one is in profit, but still holding on to this one. Let's see what happens if price is going to reverse. Okay, see some sort of okay, price is pushing, and we've hit our take profit on this trade already at this point, right? At a 1:10, we took our profits out already. Now this just goes to explain to you the concept of order blocks. Identifying or being able to identify order blocks in your trading would help to give you areas to get involved in the market. Now if you notice, we already had our premium level, we had our discount level, but we didn't quite see areas in which we should be getting involved in. We're able to identify this area from this trading zone. That was the first trading zone we're looking at, this range high here, this range low here. We're able to identify this area to take a trade from, which we did. When we saw price break this internal structure here and pull back, we didn't quite get an opportunity around here to take a trade from, right? But we saw price push up again, creating a new trading range, a range low, a range high, and then we're able to see an opportunity to take this trade from. That was this other block over here. It was at discount level. We're looking for buys because it was in line with our trend, and then next thing we saw price shoot and hit our take profits in a nice 1:10 trade, and we're able to, close that trade in profits. So these ideas or these concepts alone can help you. That's one of the major importance of an order block. It gives you the ability to be able to, or gives you an idea of those points on the charts where you should be taking your trades from. So let's take a quick recap of all we've said so far. First of all, we started off our course talking about, introducing you to the Forex market and all of that. We looked at structure. We saw its importance. Let's pause this here. We saw the importance of structure. We said structure would help us identify areas in which we should be looking at opportunities, trading opportunities. We said structure helps us to identify the trend, beg your pardon. We said if price is moving and creating higher highs and higher lows, we said that trend is an uptrend. If it's creating lower lows and lower highs, it's in a downtrend, and you'll be looking for selling opportunities. For the prior, you'll be looking for buying opportunities, right? So this was an uptrend, and we're looking for buying opportunities, just like we've been talking about. Then we introduced ourselves to the concept of order blocks. We said there are demand and supply zones. Demand zone in the case of a buy, supply zone in the case of a sell, where we look to get involved in the market. We introduced ourselves to some of the concepts. We said there are different theories in the market. We talked about the Dow theory. I mentioned the Elliott's wave theory. And we talked about Wyckoff theory, postulated by Richard Wyckoff. I don't want to go in depth into all of that, but we needed one important thing from Wyckoff theory, and that was about how price moves, the theory of price movement. We said price moves in such a way to engineer liquidity, take out that liquidity, and then give the composite man the ability to enter into those trades. And we said what we're trying to do is to take trades based on the activity of the composite man, like Wyckoff would call them, or Enigma, like Wally Khan would refer to, right? So we're able to now identify those areas, those order blocks. We gave ourselves some characteristics to look out for when we want to take trades at an order block. We said it should accumulate before the order block is formed. It should take out internal and external liquidity. There should be a fair value gap or a liquidity void. Now, the more the merrier. The more you have these characteristics, the better, or the more confirmations you get to take a trade from this particular zone. And we're able to take some examples of trades. We use them USD card. We identified such opportunities on the charts. We got involved in these opportunities, and we took 2 buy trades along with the trend. And the second one, I think they both just hit take profit, right? We're targeting this range for the first trade. We hit take profit on the second one already. And these are basically just simple concepts that you should be looking to apply to your trading. Remember, each and every step is important. The first thing you do is you identify structure, and then you determine the trend. The next thing you do is you mark out a trading range that you would be looking to get involved in the markets with. That's the second thing. The third thing you should be looking to do is to mark out your premium and discount levels. After you've done that, you look out for areas to take your trades from. That's, let's say, an order block, as is the case with us now. Once you identify those order blocks you are willing to trade from, you go ahead and you execute. Set your stop loss, set your take profits, and you're in the trade already. All right. So if you have any questions, I'd like you to drop the questions in the community, and we're going to answer them. If there's something you didn't get, I advise you watch this video again, and I'll see you in the next video. Thank you.